To On the Money right here on WDBO AM 580, always streaming inside your WDBO app. 107.3 FM, HD2 on the 96.5 FM channel. We got all kinds of ways to listen to On the Money here this Saturday morning. If you want to join the conversation, we got Joe Bert and Wynn Smith in the house today answering your questions. The number to call, 844-580-9326. Both Joe and Wynn are certified financial planners with the Certified Financial Group, giving certified information here on WDBO as they have for the better part of 4 decades on WDBO. Joe, Wynn, how you guys doing today?
We're doing great. Good to be with you, Josh. As you said in the intro, we are here to take our listeners' calls, as we have now for many, many, many years, answering questions that might be on your mind regarding your personal finances, decisions that you're trying to make regarding stocks, bonds, real estate, long-term health care, annuities, reverse mortgages, life insurance, all that stuff and more. The things that Wynn and I and the 15 other certified financial planners work with our clients, getting them to and through their retirement years on Monday through Friday for a fee. But on Saturday morning, we are here for you absolutely free. So if you have any questions, anything that's on your mind, things you've been thinking about, things you've heard, things you're concerned about, things you may want to have answers to, but you don't know where to look, give us a call, because we're here for you right now, and the lines are absolutely wide open, so you can be first in line this morning by dialing these magic numbers.
The numbers are 844-580-9326, 844-580-WDBO, or feel free to send in your open mic feature here in the WDBO app. Give us 15 to 20 seconds of your question. It can be less as long as you got that information out there, and I'll play it back live on the air for the team at Certified Financial Group. Today's topic, we got human life value. What is it? Where did it come from? And how does it fit into a financial plan?
Well, tell us all about it, Wynn.
Yeah, Joe, I recently had a case, and there seems to be a misconception that you can buy as much life insurance as you want anytime you want. And I had a case where we were trying to get the maximum amount of life insurance for a couple. And it was like, well, we can afford this. Why can't we get this? And so you can't get as much life insurance. They are the business, and they are very valuable to the business, especially professionals like doctors, lawyers, accountants, even in our business. You know, you are the business, and so there's a tremendous need there for protection, other than even your personal need for life insurance. And so human life value is that economic value of your life, and it was a concept that was created about 100 years ago by a guy named Huebner, who was a Wharton professor, and it actually led to the creation of the American College, which is now the American College of Financial Services, which has also led to the Charter Life Underwriter designation, which was the first professional designation in the financial service industry.
Which you are one, by the way.
Yes. Thank you, Joe.
You're welcome.
But it's not seen so much anymore in the insurance industry and financial planning. But a lot of that, I think, that misconception is brought on by the industry itself, because an actuary will tell you that there's 3 components to an insurance contract. There is the premium that you pay, there's the benefit that you're looking for, and the conditions on which the contract will pay. And an actuary will tell you, we'll let the client pick 2 of those 3 as long as we can pick the third. So an example would be if you wanted a $10 million life insurance policy and you wanted to pay a penny a year for that, an actuary could figure out, yes, we'll do that, but you have to die at 2:00 on a Tuesday, based on a piano falling on your head or something crazy like that. But that's not necessarily the case, because there is an affordability issue, and there's also just like you and Charles last week were talking about, the homeowner situation in California,
right? And
so there's like a big misunderstanding. Kind of get off subject for a little bit, but there is a big misunderstanding in like homeowners, because there's 2 major types of policies. There's a named peril and an exclusion. So the exclusionary policy are more broad than the named perils. And I think a lot of people are probably finding out that they had a named peril policy versus an exclusion policy.
So let's talk about those 2 things. So exclusion means?
They list in the contract what it doesn't cover, and then everything else is covered.
Like earthquake?
Yes.
Or volcano?
Yes.
So
Typically, it's like riots and things like that.
Right.
And then, but everything else is covered. So if it's not specifically named in the policy that it's excluded, you're covered.
Right.
Versus a named peril, then if it's not one of those things that's named, you're not covered.
Got it.
And that's a huge, and like in auto insurance, there's a big misconception on stacking and unstacking and uninsured motorists. But life insurance, this case I was working on was one where we were really trying to get the maximum amount of life insurance that we could for a couple. So it was their personal needs and then also the need for their business. And they had tremendous value, and we actually had to go back. We had to shop around to various insurance companies just to find somebody interested. And then we actually had to go back and make a case as to why we felt like that there was tremendous value here, and what the death needs should be.
So they had a need, obviously, for their family. Children involved?
No grown children.
Okay,
No, it was just for each other.
Just
Yep.
about, okay. But then the real value was in the business.
In the business.
The value of the business continuing, or if the income from the business should stop.
Exactly.
Right. And that's not to be confused with disability insurance.
That's correct. We're just dealing with life.
Right.
And a lot of people don't realize that the insurance companies, they look at the total amount at risk. So, your value to your business and your value to your spouse or your family, that all rolls in together. That's another reason, like you'll hear about big corporations or professional athletic teams, they don't allow all the players to fly on the same plane or travel together. It's because they don't want the plane to go down and have that huge loss.
Which has happened.
Yes.
So insurance companies are going to look at, in this particular case, so you have to provide financial information, I
Oh,
presume?
yeah, financial statements, personal and business, and we had to project growth rates. Because, again, you're looking at a 10 to 15 to 20 year term. So we're looking for term insurance. There's term and permanent. You don't want to have to go back, and as the business grows, and the business has had tremendous growth. And so we had to go back and do some projections and make some realistic assumptions.
Right.
And it was quite a negotiation.
And you want to get as much as you can while you're still young, because while you're still young, the premiums are less.
Great point.
And of course, you never know in the year, 2 years, 3 years when your health changes, and then you can't get the insurance that you want.
That is a great point, Joe. You're right. You buy any insurance you buy when you don't need it, so you'll have it when you do.
Yeah, and everybody hates paying insurance premiums.
Well, until there's a claim.
Exactly. And look at California. How many of those people wish they could pay insurance premiums or had some kind of coverage? What a disaster that is out there.
Well, and we're seeing that in Florida. A lot of people are going without homeowners because it's so expensive here. And unless you can afford to rebuild your house, I don't know if that's a good move or not.
Well, you can't do that, obviously, if you have a mortgage on the property.
Yeah, good point.
But you're right. There's some people that go bare, as we call it, and that's okay until you have that disaster, and you never know when that disaster is going to hit. And that's, of course, the whole need insurance, whether it's automobile insurance, whether it's homeowners insurance, whether it's life insurance, whether it's disability insurance, whether long-term care insurance. All those things. And the thing about insurance is really it's the rule of large numbers.
That's right.
And that's what insurance is all about, that you get enough people in the pool, knowing that some of those people in the pool are going to have a claim, and the rest of us are going to support it. It's almost kind of, I hate to say like socialism, but it's a way that, we all protect each other. And so if you're in the pool and you've been paying the premiums, you'll have the protection, you sleep at night. But if you're not in the pool and you don't have the protection, you have the hurricane, you ain't sleeping.
Well, I don't know if you saw this, Joe, but there's always moves to federalize the regulation of insurance. A lot of people don't realize insurance is regulated at the state level, and they were just talking about exactly what you're saying about if it's regulated at the federal level, then it is a bigger pool, bigger risk pool. But then the argument is, well, should somebody in Kansas be, in that pool from somebody in California? But in Kansas, you got tornado.
Echo would disappear, and so so would flow.
I think that's maybe with us.
But that's that's something something to consider. That might be somewhere in the back of Donald Trump's mind of how to solve this issue, this dilemma.
Well, with climate, the things seem to be getting more and more extreme. So I don't know if this is a solution or not. But that is one cost of doing business for the big insurance companies. Is they've got, every state has their own approved contracts. They have to go to every state to justify their rates, to justify their rate increases. That was another thing in this article I was reading. They were talking about how a lot of certain states have stricter regulations than others, and it's easier for insurance companies to sometimes get rate increases in some states than others. So they typically look to increase those rates. So people in those states are actually they actually are subsidizing people in some of the other states already. So why not just go ahead and regulate it and, have a little bit more of a level playing field?
Yeah, you're 100% right. If you look at the regulation that you go through, every state has their own insurance commissioner, own insurance department, own rules and regulations, and you have a whole bureaucracy dealing with nothing but that here in Florida. And you go to Georgia, you have the same thing. Go to North Carolina, you have the same thing. So you replicate that throughout the country. What does that cost?
I mean, just think of it from the investment side. I mean, what if we had to have a separate mutual fund or exchange traded fund for every state? Yeah. I mean, that would just be
that's wacko. So, anyway, that's the outlook on what's the topic? What did you call that? The value?
I called it human life value because that's just a concept you don't usually hear. I mean, we'll tell you who's taken that concept and run with it. That's the personal injury attorneys.
Yeah. Oh, yeah. That's when you have that claim. What was that? What was that? Loss of income worth or the loss of life worth? Exactly.
Yeah.
I hear the bumper music. Josh, take it away.
You got it. If you want to join the conversation, Joe Bert, Wynn Smith, 2 certified financial planners with the Certified Financial Group on the air today, taking your calls. Call in now, 844-580-9326, 844-580-WDBO, or send in your open mic using the free WDBO app. You're listening to On the Money, where we're planning tomorrow
today
with the Certified Financial Group.
For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the 3rd or 4th generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them.
You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the 3rd or 4th generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, oh, I like veal. What do you got?
Back to the topic.
Let's do a text question.
Welcome back to On the Money here on WDBO, AM 580, always streaming inside the WDBO app. This is your chance to hop on the air because we have financial experts, certified financial planners Wynn Smith and Joe Bert on the air right now. So now's the time for you to call in. We got open lines if you want to join the conversation. If you got something that's always been in the back of your mind or something you just read about over the news very recently, but you want to run it by the experts, we got Certified Financial Group, Wynn Smith, Joe Bert, available at 844-580-9326, 844-580 WDBO, or you can send in your open mic feature on the WDBO app. And Joe, what do you say we hit one of these text questions here?
Let's do it.
All right, we got Bill. He's got a very topical question. He goes, with drill baby drill, is now a good time to invest in oil and gas?
What do you think, Wynn?
Well, that's sector investing.
Right.
You're investing in a sector of the economy that's kind of somewhat market timing type of approach. I mean, a broader based type of investment strategy would include, oil and gas as an exposure, but I'm reluctant to do sector investment. I don't know about you, Joe.
Yeah, let's for our listeners who might not be familiar with that term, what sector investing is as the word implies, it's a specific area of the economy or some industry that focuses specifically on that. In fact, there is an ETF now that I have uncovered that is investing specifically in these weight loss drug companies. Yes.
Oh,
yes. And of course there's AI and there's the old standbys, pharmaceutical and energy, as you said. But sector investing is in many ways high risk, high return. Mm-hmm. If you're in the right sector at the right time, you can do well. And if you're in the wrong sector at the wrong time, you don't do well. And that's, now you can build a portfolio of a bunch of different sectors and you're diversified. But once again, that really isn't as... It's still a higher risk, I would say.
Yeah, and
probably I guess more people want to play.
Yeah, and if you put it into that, I mean, it'd be like there's that opportunity to swing for the fence and hit a home run.
Right.
But again, I wouldn't want to be putting a large part of my percentage of my portfolio in something like that. That would kind of be almost like play money, gambling money, or just kind of. I mean, there's nothing wrong with following different trends. I mean, there is that satellite philosophy, or core satellite, where you have the bulk of your your wealth tied up into something that's core, that's diversified, and you got a few satellites out there floating around where you're maybe you'll hit a home run, maybe the weight loss, maybe the AI. I mean, who knows?
Right. And, I think it's a distinction between investing and speculating.
Good point.
And speculating is exactly what we're talking about. You're speculating on this specific industry at this specific time to be doing well, and you need to understand that industry and understand who the players are, whereas investing is really for long term. You don't jump in, you don't jump out. You're not making gut moves. You're not making what you just heard on the TV or, heaven forbid, on the radio on Saturday morning. You're making decisions really with your long-term plans in mind, and you're not moving the chess pieces around on a daily basis, weekly basis, on your phone, whatever you're doing. I mean, that's, and unfortunately, people fall prey to that because you think you can control your destiny to some degree on that, and you never know what's around the corner.
I will add this, Joe. Sometimes if I'm working with a client who has that desire, my recommendation is, well, let's look at some type of sector fund in the sector that you're in. So like if you're in construction, well, I'm sure you're reading the trade magazines. I'm sure you kind of know who the players are. You know what the trends are. So let's look for something that's construction related or medical, or pick the sector.
Yeah, that's the way to do it. But I would suggest that if you're going to have us manage your money for you, that we will carve out some money that you can put in your special investment account that you're responsible for. But we're responsible to get you 2 and 3 retirement years. And we don't want this thing to blow up simply because we allowed you to make a decision that we didn't think is your long-term best interest. It's always your money.
Yep.
We'll work with you, give you guidance. But if you want to do the speculation, that's not what we do. I hear the music, Josh. Take it away.
Thank you so much. Joe Bert, Wynn Smith, Certified Financial Planners with the Certified Financial Group, here to answer your questions. 844-580-9326 is the number to call. Send in your open mic using the free WDBO app. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
On skirt steak. We got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got $200,000, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
Peace of mind that we now have, that's everything to us.
The people that work here are honest and caring, and I feel like I can go to sleep at night.
So schedule your no-obligation visit today at financialgroup.com, where we're planning tomorrow, today. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them, and they were totally correct how good they are.
I had heard from somebody else that it was the best one in town.
I've sent several of my teacher friends here.
We're Certified Financial Group, where we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Black Monday.
On the money here on WDBO AM 580, always streaming inside our WDBO app. This is your chance to hop on the air, to sit at the table with some certified financial planners. And I'll tell you, some financial advisors are like plumbers. They're like doctors. They're like lawyers. If you know one, you're going to ask them questions because the knowledge they have is just so valuable, and there's so much schooling and memorizing, and maybe I'm just a radio guy, but it just really is a great resource to have. And we just happen to have two on the air today. We got Joe Bert and Wynn Smith, two certified financial planners with the Certified Financial Group in the house today. If you want to join the conversation, we got some open lines, 844-580-9326, 844-580 WDBO, or send in your open mic using the free WDBO app. Joe, Wynn, did you want to go back to the topic here? We got another question here.
Yeah, I know we've got a text question in the queue, but I just wanted to elaborate a little bit on a couple of points that Joe made. One of the things about human life value, and this is kind of an issue that has been around, but it's now changed, thank goodness, is a lot of times when you had like a single breadwinner in a family, you had a stay-at-home spouse. That stay-at-home spouse couldn't get life insurance because they had no income. But now the economic value that someone brings to the household, whether it's, rearing the children or, cleaning the house, cooking, working as a chauffeur, all those factor into your human life value and the economic value of someone. So that's like the comment I was making about the personal injury attorneys have pretty much taken over this concept, is because when they're suing for a wrongful death or something like that, I mean, they're looking at everything they possibly can and putting a dollar amount on that, which is, it's a good thing for people that don't necessarily have monetary value, but there is economic value with a lot of folks.
Yeah, without question. To replace those services is very high.
Very expensive.
Very high.
Right.
Okay.
And then the other thing I wanted to point out is that part of the Certified Financial Group is Certified Insurance Corp. We actually have an independent insurance agency as part of us. Now, we don't sell insurance. What we do is we buy insurance for the benefit of our clients. So it's kind of a different situation. And I know we talk a lot about being fiduciaries and how important it is to work with a fiduciary. And a part of being a fiduciary, other than putting the client's best interest before your own, is if there is a conflict of interest. And in the insurance industry, there is, because in the insurance industry, they pay commissions.
Right.
So when you're in a situation like that, to honor your fiduciary duty, there's a couple of things you do. Like, one of the reasons we're an independent brokerage is because we have access to well over 100 different insurance companies. And so we have the ability to go around and look for the best fit for the client. And then also, we don't, because there is a commission paid, that is a conflict of interest. But the way that I personally deal with is I don't even look at that. I don't even want that subconsciously influencing my decision. So I have no idea what the commission is on any products that I'm using with the client or fulfilling a financial plan.
And in many cases, particularly in areas of annuities, you can buy those annuities without commissions.
That's true.
So you can get, and those are the best ones out there because they get a lot of flexibility to them. You get very, very liquid, as opposed to getting those things that offer the 30% bonus and a 12% increase in your income, which have you tied up for the rest of your life. And once you bought it, it's it's like a trap. You can't get out of it.
Right, and you're seeing, and that's a good point, Joe. And they're starting to move now toward fee-based life insurance with cash value type products. The industry's trying to develop that. But the thing with insurance is the insurance company sets the price, so you're going to pay the same regardless of how you get it. So it's not like there is you're paying more, but there could be companies that pay a higher commission than others, but again, that doesn't come into the analysis.
And I think what you want is independence.
Exactly.
You're not what's called a captive agent, where you're representing the company.
Absolutely.
There's nothing wrong with that.
Right.
But then you're going to deal with a lot of different companies. I see our lights flashing off and on here this morning. I don't know what's going on. Sorry. Okay, I saw a text question float in there, Josh.
You got it. If you want to join in, numbers to call in, we got some open lines for you. 844-580-9326, 844-580-WDBO. Send in your open mic using the free WDBO app. This next question comes to us from Betty, and Betty's going through a tough time, but she's got a simple question. She says, I just lost my job. What should I do?
Oh, well, that's not uncommon.
No, in fact, that's one of those major life events that a good financial plan will address. Just kind of to run this down, the worst thing that can happen to you is death of a child. Second is death of a spouse. Third is divorce. And fourth is an unexpected job loss. So, Betty, I'm sorry to hear that. I guess my first thing would be there's quite a few things you can do. All right. So the first thing would be to look at your budget, get a good handle on your budget, and just see what you've got that you have to pay and what the fluff is. Because a lot of people that get into trouble is that time frame that they have between they find the new job and they lost the old job, is they don't adjust their lifestyle. They try to maintain that previous lifestyle, and that gets them in trouble. And typically that gets them in trouble with credit card debt, and you're just digging a hole. So quit digging a hole is the first thing.
Yeah, that's a good point. Wake up and smell the coffee and realize you've got to retrench. Don't continue to live if you're still getting a paycheck, because you want to deny the fact that I'm going to be okay. I can continue to do the things that I want to do when I want to do it, even if it takes putting on a credit card for a period of time. But boy, once you do that, you are digging the hole deeper.
And I guess the other part would be, did you get a severance? I mean, so that might help you out a little bit. Factor that into your budget and see what you've got there. The other thing I would do is I would look at contact my HR director. And I mean, do you have COBRA? Do you have the ability to continue some of your benefits, or some of your benefits convertible? What does that look like? And because there's some benefits you want to keep in place because you don't know what you're going to get into with a new position.
Yeah, that's critical. Maintain your health insurance, because if you have a claim and you're still unemployed, excuse me, you've just dug the hole even deeper. So let's talk about COBRA. You hear that word a lot.
Yeah.
We know it's a snake, but in this particular case, it can be a friendly snake.
Yeah, you can, with COBRA, it's an acronym for continuous, I don't know what it's something, but anyway, it's the law that if you are separated from service, that any group benefits that you have the ability to continue those up to 18 months upon that separation. Now, The difference is that if your employer was paying some of the premiums for some of those benefits, they are no longer required to pay those premiums. But in many cases, the premiums that you have with a group plan, kind of going back to our previous discussion, with a group, you've got a bigger pool of people, so you've got you may not be paying less. Now, that used to be pretty much always the case. Now it's not so much the case because the place where you're working may have, since we've got 4 generations in the workforce now, depending on the demographics of your workplace. If you're a younger person and the average age in your company is much older, you may be able to get something individual less expensive than group. So maintaining those, look at those COBRA benefits, then that'll give you kind of a baseline as to what you're going to be spending for certain types of benefits.
And there's a time to, maybe you said this, excuse me, to apply for COBRA.
Yes, you have that. I think there's a 30-day window that you have.
Yeah, you can't wait 60 days or 9 days, or wait you're not feeling well, you're in the hospital and try to get the COBRA.
Yes, going back to the earlier point that, you buy insurance when you don't need it, so you have it when you do.
And COBRA stands for Consolidated Omnibus Budget Reconciliation Act.
Oh, thank you, Joe.
Well, it's, thanks to Google, Consolidated Omnibus Budget Reconciliation Act.
So I guess it was tacked into that budget act.
Yeah, the Reconciliation Act, that's it. That's all it is, okay. So that's, Betty, feeling bad for you, but those are the things you need to consider. And the key is that you want to have some emergency money stashed away, because that's the secret to get you to rough times. And you got to have that. It's not invested money. This is money that should be tucked in a sock somewhere, as Nancy calls it, toe with the sock money. And have the money stashed away, knowing that there's going to be times when you're going to need to fall back on that.
Yeah, that's cookie jar money. That's mattress under the mattress money. And you're right, Joe. And that's another good point. I mean, kind of the rule of thumb is 3 to 6 months, but that's also a personalized amount, because if you're younger, you probably don't need as much as a cash reserve, and depending on what profession you're in, because you may be able to put your resume out to 2 or 3 headhunters and be working the next day. Typically, as you get older, it takes longer to replace your income from a previous job. Mm-hmm. So typically with planning, you want to be building your cash reserve and keep increasing your cash reserve as part of your plan as you get older.
And if you're in a low enough tax bracket, use a Roth account, because a Roth has flexibility. You can withdraw your own money at any time with any kind of penalty. If you leave it in there, it'll continue to grow tax-free. So that's, it's what planning is all about. It's not just investing or those kinds of things.
And the other thing about a cash reserve is it kind of functions as a bridge between your insurance and your investing part of your financial plan, because with insurance, you have deductibles, as a lot of people in California are realizing now. And so if you can kind of adjust what you're paying for insurance by increasing your deductibles or increasing your waiting period on disability insurance. So there's a lot of things that you can modify on the insurance side, but you need to have that cash reserve built in, so if you do have a situation, you can handle that deductible.
Right.
And then the other part is, if you don't want to be drawing on your investment portfolio, because again, as you mentioned earlier, that's your long-term safe money that you're planning for the future.
Right. Certainly not your IRA or 401k if you've got to take it out, because depending on your age, you might be taxed on it, or might be penalized on it, and that's so that's a money of last resort, if you will. But if you have a Roth, and you can take the money out, your own money that you put in there without a penalty, it's not a bad way to go. So those are all the things that need to be considered. So I see we got one more text question floated in there, Josh.
That's right. Again, if you want to join in, the phones are open, 844-580-9326. Todd from Baldwin Park asks, he says, I want to teach my 10-year-old child money lessons. Way to go, Todd. He said, do you guys have any suggestions on where to start?
That's the greatest gift you can give your child, is teach them about money. I don't know about you, Joe, but I had an allowance I had to work for when I was a kid. And I think that teaches a kid that, your labor produces income, which is a good lesson. So, a 10-year-old's probably, the 10-year-old, I was cutting grass and doing stuff like that.
I was cutting grass with a push mower.
I didn't have it that bad.
Push mower, my friend.
There is a famous story about one of the Rockefellers. I don't know which one. It's very hard. It's very unusual for wealth to continue multiple generations. Right. There's a lot of studies where, especially small business owners, or just wealth in general, that a lot of times people will sacrifice. In fact, there's a story, the couple, they didn't buy the boat, they didn't take the world cruise, they didn't join the country club so that they could leave something to their kids. And as soon as they die, what the kids do, they buy a boat, join the country club, take a world cruise, right? Right. So, giving your children money is not necessarily a good thing, but teaching them about money is a great thing. But going back to the story about one of the Rockefellers, he would give, and again, I don't know which one it is, but he would give his son his allowance every week, and he gave him a little book, a little notebook, and what he required him to do was to track every penny that he spent. And then once a week when he would get his new allowance, they would open up the book and they would go over how he spent his money. And that's how he taught him to save so much, give so much to charity, and enjoy the rest.
Warren Buffett's rule of thumb by leaving money to your kids, and this is what he's done. He says you want to leave them enough so they can do something, but don't leave them so much that they don't have to do anything.
That's good.
That's a good saying. Yeah, you leave them so much they don't have to do anything, and then the money is gone and never passed on to the next generation unless you're very, very careful. So those are all the things to be considered along those lines. We've got a workshop coming up, right, Wynn? What's going on?
Yeah, we do. We have one coming up on February the 8th. Gary Abley is going to be hosting that, and the subject is tax-efficient investing and distribution strategies, and that's going to be here at the Learning Center from 10 a.m. to noon.
So those are absolutely free. Go to our website. That's financialgroup.com. Financialgroup.com. You can make your reservation right there online, and hope to see you there.
And if you want to join the conversation, 844-580-9326 is the number to call. 844-580-WDBO. Send in your open mic using the WDBO app. We got Charles Curry taking call. Forgive me. We got Charles Curry taking calls off the air. If there's a personal question or you want to, that question comes to your brain after we close the mics here on the money. That number is 407-869-9800. It's the same format. Give him a call. Tell him you heard him on the radio, and it's like your own private little radio show. Charles Curry is the host, and you are the guest. 407-869-9800. You're listening to On the Money, where we're planning tomorrow.
Today.
With the Certified Financial Group.
The dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that ChFC demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a ChFC certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a ChFC certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite. Marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is
WDBO AM 580, 107.3 FM, 98.65, 96.5 FM, HD2. Always streaming inside your WDBO app. This is On the Money. Certified financial planners Joe Bert and Wynn Smith guiding us through another great hour. We got a caller calling in. David, good morning. You're live on the air.
Good morning, David. What's up?
Hey, good morning. I've got a situation where my father passed last year and we had to sell his residence. My stepmom is still around, and my question is going to be related to the capital gains exposure she's going to be now facing. When they bought and or built the house, cost was roughly $500,000. The house sold for 1.5, so the exposure is $1 million. When my dad passed, we did a ladybird deed. So the question is, the $500,000 of relief from capital gains versus when we did the ladybird deed, the value of the property at the time of death will almost wipe out that exposure to capital gains. So does she get the total $500,000 for capital gains release, or is it only $250,000? And then when we did the ladybird deed, the value of the property at the time of the deed versus when they built it. Because the value of the property at the time of the ladybird deed versus the sale of the house is almost a wash.
Well, I'm not aware of any stepped-up basis with the ladybird deed.
No. No, I'm not either. But so your dad passed away. Your mother, I presume they were joint owners.
Yes.
Okay. So.
And the Lady Bird deed was in place before he passed, so that was the transfer.
No, it was after.
It was after.
Transfer ownership totally to her. So that transfer and protection of ownership to straight up to her, did that wash $250,000 of capital gains exposure, and now she only has $250,000 of exposure? Or is it per property?
No, it's not per. It's not per. It's not per property, and you'd have to be married filing a joint return to get the full $500,000. That I know.
Right.
So that may be the answer.
And it has to be your primary property.
It has to be primary residence, right?
And it was. Yeah, it was.
Yeah. Yeah, I can't. I don't want to give you a definitive answer there, but my gut tells me 250 is going to be the limit, because the $500,000, in order to qualify for that exclusion, you have to be married filing a joint return to get it.
Yeah, I agree. Is there any way that your stepmom can limit her income? I mean, so maybe you can get down into a lower capital gains bracket. I mean, that's the only strategy I can think of off the top of my head.
Right.
Yeah, luckily her income is just retirement funds, so they're minimal.
Well, in that case, she might not owe much on capital gains taxes.
Well, the balance, the delta is the cost to buy and build, which is again roughly $500,000. The $250 now that I'm understanding she only has capital gains relief from, so that's $750. The house sold for $1.5 million.
Oh, okay.
So she still has to pay capital gains.
Yep. Yeah, David, I think she's limited to the $250. We appreciate the call. We're up against the clock. I hear the music.
Thank you so much again. Charles Curry standing by off the air to answer your questions. 407-869-9800, 407-869-9800. You just listened to On the Money, where we're planning tomorrow.
Today!
With the Certified Financial Group.
WDBO Orlando, WOEX.